Hi, everyone. It looks like we've got a number of participants joining us, and we're going to wait just another minute or so until the rest of our participants have joined, and we'll get started then. Okay. Good morning, everyone. My name is Tara Ablett. I'm a manager here in the tax department at Clayton & McCurvey. We'll be hearing from Sarah Russell today, who leads our tax department. She's been providing updates from Washington, which we'll get into in a little bit, and also talk about some year-end planning considerations and thoughts on the ERC. Just a couple of housekeeping items before we begin. We do respect your time, so you can expect we'll be done promptly by noon today, and we will have a recording of this presentation on our website in the next day or two. Also, on the right of your screen, you will see a questions box. You can ask questions throughout the presentation, and we'll be answering those. Some of the specific items we may address offline, but there's an uptick feature in the questions. So if someone asks something that you're interested in hearing about, be sure to use that feature and we'll address it at that time. So I think we're ready to begin. Sarah, I'll turn it over to you.
Thanks, Tara. Welcome, everybody. Thanks for joining us today. We appreciate your time. Just wanted to go over quickly what our agenda is going to be today. We'll talk a little bit about the Buildback Better Act, what's included in it, what's the status of it. And then after we get through that information, we'll talk a little bit about some year-end tax planning strategies that you might want to think about in light of some increased tax rates that we think we're going to probably see in 2022. I'm going to get right into it. So what is the status of the Buildback Better Act? It's evolving every day. I think every day I hear something new is going on. But earlier this week, Senate Majority Leader Chuck Schumer had announced that he hoped that the legislation would pass before Christmas. But the progress has been slow, and many people think that timeline might be optimistic. There are several things that need to happen before the Senate actually can vote. Because they're trying to pass this bill, also known as the Budget Reconciliation Bill, using the reconciliation process, meaning they can pass the bill with only Senate votes on it. They don't need any Republican votes on it. They need to send the text of the bill through the Senate parliamentarian. It's a pretty procedural process, but really what the parliamentarian will come back and say is, yes, it meets the rules to allow this legislation to be passed without the ability for the Republicans to filibuster the bill. So the final text is yet to be submitted to the Senate parliamentarian to review it. And part of that is because some of the text is still being drafted. While this legislation passed the House, it passed the House with the assumption that the Senate would come back and make changes and amendments to the legislation as it was already drafted. And as some of that drafting is happening, it needs to be resubmitted to the parliamentarian to say yes or no, can this bill be passed without a Republican filibuster? Once that happens, the Congressional Budget Office will need to score the bill. And that's going to be an important step because there are Democratic senators who are looking for that score before they'll commit to a yes vote. And there's two real holdouts, and we'll talk about that in a minute. But, there's a couple of people who have essentially said, I won't vote yes on this bill if it adds too much to the deficit. And without full Democratic support, the bill will not pass because they have such a thin majority in the Senate. Once the bill does pass the Senate, it will then need to head back to the House for another vote because I don't think it's going to pass the Senate the way the bill was submitted to the Senate from the House. So it'll need to go back to the House for a vote before it actually becomes legislation. And I think for all of those steps to happen before Christmas is pretty optimistic because the Senate also has a slate of other priorities that they're working through at the moment. What are those priorities? They still need to pass the National Defense Authorization Act, which is required to fund defense spending. Now, the House did pass that legislation yesterday, and it's expected that the Senate will vote on it sometime this week. I don't know what day yet, but the announcement today was that would be expected before the end of the week. But that is certainly something that's going to take up Senate time and away from this Budget Reconciliation Act. The other big issue that's out there is addressing the debt ceiling. That deadline is expected to be December 15th. That's come from the Treasury. Janet Yellen has said, hey, without increasing the debt ceiling before the 15th, we'll start defaulting on our government debts. The House did pass that legislation last night after Democrats cut a deal with McConnell. There's some procedural voting that needs to take place as part of that deal that they cut. And so they're expecting that will happen sometime early next week in the Senate. The Senate will vote on that. So there's two huge things that are also taking legislative time away from the senators as they're also trying to adjust this huge, massive budget reconciliation bill. A few other things that have come up and sort of are throwing some wrinkles into the timeline. President Biden is still trying to push through nominations that have yet to be done, and those things are taking up time on the Senate floor. And then, U.S. Senator Bob Dole passed away, and there are services that are happening in the Capitol this week, which are expected to cause some legislative delays as well. So all of these things are happening at the same time that they're trying to pass this budget reconciliation bill, and all of which takes time on the floor. And so the timeline to get this done before Christmas seems pretty optimistic because Christmas is Christmas Eve is 16 days away. So they have 16 days to get it all done. It seems like a pretty hefty agenda. I think some of the comments coming out from President Biden this week also seems to indicate that he believes that this might fall into next year and might not actually happen before the end of the year. Time will tell. What are the big obstacles? What is stopping this from passing the Senate? There are two senators, Senator Joe Manchin of West Virginia and Kyrsten Sinema of Arizona, who have both been sort of blocking the passage of this bill. And that has been happening all along the way. They really held up legislation from passing in the House because House Democrats were trying to ensure that the legislation drafted out of the House would pass the Senate, would meet all of the requirements from their caucus in the Senate to become legislation. In the end, they didn't quite get there, and they realized that, it's better for us to actually just get a bill out to the Senate and let the Senate start negotiating and making changes and amendments so that way it starts getting through the process. A few things that Manchin is seeking to pare back in the bill include paid family leave. Currently, the bill has 4 weeks of paid family leave included in it, and he wants to take that out of the bill. He also, being from West Virginia, he doesn't like some of the credits that are being offered for electric vehicles produced by a union shop. He wants to eliminate a methane fee on emissions, and he also doesn't like all of the Medicare expansion that's included in the bill. Part of this is, Manchin is more of a moderate Democrat, and he sort of looks at it and says, this is a huge spending bill. It's going to throw a lot of money into the economy, and we're already in an inflationary state. And is this the right time for these things to happen? And so while he's certainly expressing some concerns about things that are in the bill, I think at this moment, it's pretty unknown as to whether or not he'll even support the bill at all because of the inflation that we're seeing. Sinema has not really made her required provisions public, and she's just merely commented that she is negotiating behind closed doors, and she feels like that is a more productive way to do it rather than being public about it. So it's pretty unclear what she's going to require to change in the bill. She was the biggest factor of not including the tax rates that a lot of the House Democrats, as well as President Biden, wanted to see in the bill. She made it very clear that she would not support a corporate tax increase, and she really didn't support an across-the-board individual tax increase. We'll talk about some of the things that are included in the bill, because in reality, she's endorsing some tax increases that are a little bit hidden, I would say. They're not blatant tax increases, but there's certainly a fair amount of tax increases included in this legislation. And then, as I said before, both of these are important because in order to pass the Senate, it will require a unanimous Democratic vote, and including Kamala Harris will also have to come in and be the tie-breaking vote on this legislation. So one Democratic senator in the Senate can hold this bill hostage and make it not pass and not become legislation. So all that being said, what is included in the bill, and if this bill comes to pass, what things can we expect to see? The one, it's not necessarily a corporate tax increase, and certainly for our clients, it doesn't impact a ton of our clients, is this idea of a corporate profits minimum tax. It's applicable to corporations with adjusted financial statement income over $1 billion. But it's also applicable to corporations with foreign parent companies who have adjusted financial statement income over $100 million. And basically the tax is meant to say, you will have to pay, large corporations who meet these thresholds will have to pay a minimum 15% of its adjusted financial statement income for the year. We're not going to go into the details. There's some pretty complicated calculations that you got to go through to actually determine what that tax is. But if you are a foreign-owned company with over $100 million of financial statement income, be aware that this tax could apply. And the provisions suggest that this tax would be applicable beginning in 2022. So it would be something that you would need to plan for in the next calendar year. The big one that I think will impact a lot of our clients, and this is applicable to pass-through companies, S-corps, partnerships, LLCs, is the limitation on excess business losses. If you remember in 2017, when the Tax Cuts and Jobs Act passed, there was this new term called excess business losses. It was a new tax concept where S-corps or partnerships or LLCs that had operating losses for a year, pre-Tax Cuts and Jobs Act, you could take, a taxpayer could take those losses to the extent that they had basis in their company. So if they had wage income, guaranteed payments, capital gains, interest, dividends, any type of other income, that income could be fully offset with operating losses from a pass-through company, as long as they had basis in that company. This concept said, we're going to put a limit on that, and you can only take losses up to $500,000 if you're married filing joint, single taxpayers $250,000. And the Tax Cuts and Jobs Act said if you have business losses in excess of those amounts, they would carry forward into the next year, and they would become a net operating loss and then be subject to the net operating loss rules, which the Tax Cuts and Jobs Act implemented a limitation and said you could only use up to 80% of net operating losses to offset income, meaning you would pay tax on 20% of your income. The Buildback Better Act is changing those rules, and it is making that excess business loss carry forward continue to be an excess business loss, meaning it won't flip to an NOL, and instead it will be subject to that $500,000 or $250,000 limitation, and that will continue to carry on until those losses expire. The proposed change is effective for 2021. So if this bill passes, there could be a situation where you had excess business losses that you were expecting to be net operating losses, and you were sort of planning for that, and you may have to change gears pretty quickly. I don't know. I haven't seen the detailed legislation on some of these rules yet to see how does that impact the excess business losses that were incurred prior to 2021. So if you have losses from 2020, are they going to continue to be these excess business losses and limited to only $500,000? Or will those losses be net operating losses and subject to the 80% of income limitation? That part I don't know. I'm still waiting for some clarification there. There are a couple other there's certainly more in this legislation. I'm just sort of going to talk about some of the highlights that I think will impact the most of our client base. I'm not going to talk a ton about some of the large corporate stuff because that's not a large part of our viewing audience right now. But there is a limitation on certain divisive reorganization. So there's certain times you can do a reorganization in a tax-free manner. And this act is suggesting that those tax-free, those taxpayer beneficial rules that exist today, they're going to strip some of the ways that you could do that out of, and so make some certain reorganizations tax-free. And it's really applicable if you hold what they're going to call non-qualified preferred stock and debt securities. If those two things are involved in a reorganization, it may be much harder or impossible for it to become tax-free. The other big one that's out there is the limitation on gain exclusion of qualified small business stock. Currently, Section 1202 allows for the gain on qualified small business stock to be excluded up to 100% on the first $10 million. And these rules are going to change that so that you can only exclude 50% of the gain. And so you'll pay tax on 50% of the gain. And it is also subjecting the capital gain tax, that gain to be subject to the 28% capital gain tax rate instead of the 20% capital gain rate. So in reality, what would happen is, upon the sale of qualified small business stock, you'd be subject to a 14% capital gain rate once you factor in the 50% exclusion and the 28% rate on that first $10 million. The gain in excess of $10 million is subject to normal capital gain, but these rules allowed you to exclude that first $10 million of gain, and they're going to they're going to limit the benefit of that in these new rules. Tara, do we have any questions so far?
None yet.
Okay, great. So some individual provisions that are included in this legislation, the state and local tax deduction, also known as the SALT deduction. The Tax Cuts and Jobs Act limited the benefit of that deduction to $10,000 for all taxpayers. This is currently being negotiated. So that limitation was set to expire in 2025 under the Tax Cuts and Jobs Act. If you remember when that act passed, a lot of the individual provisions sunsetted in 2025 or 2026. And this was one of them that sunsetted, and it would have gone back to the normal deduction that you were used to seeing pre-2017. As the bill was written in the House, it increased that limitation from $10,000 to $80,000, and it extended the cap through to 2030. So, if that bill passed and nothing was done in 2031, you would go back to full deduction for your state and local taxes. And if you remember, that includes state income taxes as well as real estate and property taxes. This is one of the provisions that's being negotiated pretty heavily in the Senate right now. And there's disagreement in the Democratic caucus as to what path they want to go down. There are senators from some of the high income states, such as New York and California, in the caucus that are pushing for no limitation on the SALT deduction. Last night, it came out that there's been some agreement between those senators that they would settle for unlimited deduction for taxpayers with income up to $1 million or close to $1 million. But Bernie Sanders has come back and said that he doesn't accept that. He believes that that's a tax break for the wealthy, and he wants that income cap to be that income threshold to be capped at $400,000 to $500,000. So I think that there's still a fair amount of negotiation and change that we're going to see here. I'm not yet quite sure where that will end. I think it's going to end up more than $80,000 for some taxpayers, but TBD as to what that will look like. It's definitely one of the big negotiating pieces that's pretty caucus wide. The caucus is pretty divided as to where they want that piece to land. The other big, and this is what I consider to be one of the big hidden tax increases, if you will, that's sort of flown under the radar. It doesn't seem like it's gotten a ton of publication, which is a little bit surprising to me, is the expanded application of the net investment income tax. So the net investment income tax was enacted, and I don't remember the year, but it was enacted as part of Obamacare. When Obamacare came about, this was one of the taxes that came about to help pay for that subsidy. And the net investment income tax has always, since inception, has been only applicable to investment type income. So you think dividends, interest, capital gains, that type of income is what would be subject to this net investment income tax, which is 3.8%. Active trade or business income has never been subject to this tax. This act will now subject all trade or business income, passive or active, to the net investment income tax. The other part that was excluded from the net investment income tax when it was originally enacted was if you sold a partnership interest or your stock in an active S corp. If you were an active member of a pass-through entity and you sold either the underlying assets or a partnership interest or the stock, that gain from the underlying assets that are related to an active trade or business was not subject to the net investment income tax. It will now be subject to that net investment income tax. And the provisions enact this piece of it, I think, as of like September 12th, 2021. So it is going to be it could possibly be a retroactive provision. So keep that in mind. There is some language in there that protects binding contracts that were enacted before that date. But if you have transactions that are happening right now that haven't closed, that may not have had a binding contract before that enactment date, it is possible that you could be looking at an additional 3.8% tax on those gains. As this drags on, if it drags on into next year, it seems a little less likely that retroactive date will be applicable, but anything is possible. And so I think everybody should be aware that's a possibility. The other, not quite so hidden, but other big tax increase is this surcharge that they're calling it. So the act imposes a new surcharge equal to 5% of income in excess of $10 million. So if you had taxable income of $11 million, you would pay your regular income tax rate on the whole $11 million plus an additional 5% on the $1 million, the amount that's in excess of the $10 million. And then it also imposes an additional 3% surcharge on income in excess of $25 million. So any amount above $25 million ends up with a surcharge of 8%. With these surcharges, and, so I look at some of our taxpayers who are going through transactions who ordinarily may not have $10 million or $25 million of income, but in a transaction year, maybe they will. And so you will now be looking at transactions could throw a taxpayer into these high surcharge amounts and plus the net investment income tax. And suddenly you're paying an additional, 11.8% of taxes than you would have in today's climate on the gains in excess of $25 million related to the sale of your business. So certainly changes some of the economics when you're going through a transaction, and certainly should be thought about and planned for if you're considering exiting a business in the next 12 months. Make sure that you factor these surcharges in, and you could certainly wait to do it to see if this passes. But anybody who's talking to investment bankers now should really keep that in mind, because that's a pretty big difference. 11.8% coming right off the top line of what you're thinking you're going to get back. A couple other provisions that are included here are some changes to require some new restrictions on retirement accounts. It will prohibit new contributions to a traditional or Roth IRA if the total value of a taxpayer's Roth IRA and defined retirement account, so a 401k account, if the combined value exceeds $10 million at the end of the prior taxable year, you can no longer contribute to your traditional or your Roth IRA. It also imposes new requirements for minimum distribution and similar accounts. So your required minimum distribution, if you had a value in excess of $10 million, is going to be a different calculation. And really the point is to require you to distribute 50% of the amount in excess of that $10 million. It also changes some of the planning opportunities that existed out there, which is, traditionally taxpayers who are over the income threshold to make a deductible regular IRA contribution. They call it the Backdoor Roth IRA. You can make a non-deductible contribution into a regular IRA and then convert it to a Roth IRA. They're changing that. They're eliminating that loophole so that will no longer exist. And that's expected to happen effective January 1st, 2022. One other thing is it extends the expanded child tax credit that was enacted with the American Rescue Plan for 1 year. So there's a large segment of the population today that are getting monthly payments for 50% of their child tax credit, and the child tax credit has been increased, and they're going to continue. And that was supposed to expire at the end of 2021. This legislation extends that through 2022.
Sarah, before we move on, we do have a couple questions, if you don't mind taking a moment.
Sure.
Related to the net investment income tax and the changes there, do you know, have they said whether that will apply to gifts of stock to siblings?
I do not know. I don't know that off the top of my head. I do know that it does, the net investment income tax is applicable to estates and trusts, but I don't know how the gifting part of it would work.
Okay, we'll stay tuned and hope they provide that. Another one is related to the surcharge taxes. So you've mentioned a couple of different things. Are they cumulative? So someone asks, if there's an additional 5% on top of the 10 million plus the 8% above 25 million, that's 13%. Are they adding the two, or is it just?
It's the amount that's the additional amount in excess of 25 million is 3%. So the total is 8% on the amount over 25 million. Okay,
great. And then going back to your previous slide, we had a couple of questions related to the 1202 and the excess business loss. So do you have any idea when the 1202 exclusion rules would take place? Is that 2021 or in the future?
I believe, I have to double check. I believe that one, it would be effective January 1st, 2022.
Excellent.
What I don't know, so I've read the House legislation, but I will admittedly have not read 100% of all the details in the House legislation, only because I know it's going to change. What I don't know is how they'll handle qualified, business stock, if there's any look back, if there will be a look back provided, right? People have reorganized corporations at times to make sure that they meet the qualified business stock rules. And I don't know if there'll be any carve out or grandfathering in for that. My hunch is no. My hunch is it doesn't matter if it's qualified business stock, but whether or not if you sold it, like oftentimes the legislation that gets drafted does have some clauses in there that protect you if you had a binding contract before the enactment date. And I don't know if this piece does off the top of my head.
Okay. And then last one is related to the excess business losses specific to a partnership. Do you know if that's all losses? Is it, ordinary losses and maybe, capital losses, or is it just in total? And then where can we learn more? Basically the bill, I presume.
Certainly the bill, but it's not the easiest read. So excess business losses are really an ordinary income concept. If you had capital losses flowing through from a partnership, it would be subject to the regular capital loss limitations, which capital losses on an individual return are limited to the amount of capital gains plus $3,000. So the capital loss rules haven't changed. That would still exist. So this excess business loss limitation is really an ordinary loss limitation, not a capital loss limitation. There's no change there. So you would, if you had ordinary losses coming from a partnership, those ordinary losses would only be available to offset $250,000 of other income if you were filing single, or $500,000 if you were filing jointly.
Great. Thank you for that.
We will certainly, once we know where this bill ends and lands, and once it gets passed, we'll certainly issue some more detailed guidance. We've intentionally kept everything fairly high level just because there's been a lot of moving and changing parts. And so, it's easy. It could be easy to spend a lot of time to get a lot of content out that has a lot of detailed information. But when the reality is that you really don't know what's going to be included in the bill, what's not going to be included, it's a little bit more difficult to commit that time, because you don't want to have old information out there that people look at and think is new information when it's outdated. So I'm not going to talk for a long time on this, but there are some international provisions that will be impactful to a fair amount of people out there. And the big ones that I see that will be the most impactful to our client base are the modifications to the deduction for foreign-derived intangible income, as well as the global intangible low-taxed income, or the GILTI calculations. These two concepts were introduced with the Tax Cuts and Jobs Act, and the FDII deduction allowed for a deduction on essentially what amounted to export sales, but there's a lot of really detailed rules around what is a qualified export sale. It allowed a deduction so that the income related to those sales was taxed at a lower rate. Currently, that rate was 10.5%. So it essentially meant to be if you were in a corporate environment. So this deduction was only allowed for C corporations first. And so essentially 50% of the rate is what that income would be taxed at. So 10.5%. This is reducing the deduction that you get, so that the value is really worth less. It results in an effective FDII rate of 15.8% instead of that 10.5%. So it increases the rate on that. The GILTI calculations are going to change quite substantially. Currently, if you are a 10% owner of a specified foreign corporation, you could be subject to what is considered to be a GILTI inclusion. And if you're a C corporation, you could have a deduction against that GILTI inclusion up to 50%. So you would pay 10.5% tax on this GILTI income. And GILTI income is not repatriated. It's income that's sitting in a company, a foreign controlled company generally speaking, that you have not issued a dividend on. And so this concept was really made to prevent the continued deferral of income tax in the United States on income that's being earned in foreign jurisdictions from U.S. owners. And under the current regime, you look at all of your foreign corporations, all of the specified foreign corporations that you're a 10% owner of, and you can aggregate the income or losses across all of those companies, regardless of what jurisdiction they're in, to determine what your total GILTI income inclusion would be. This rule changes that, so you can now only aggregate country by country. So if you had income that's earned in the British Virgin Islands, which is taxed at 0%, but you had losses that were earned in China, which generally on income has a 25% tax rate, you could no longer use the loss in China to offset the income in the British Virgin Islands to come up with your global intangible low taxed income. And you also cannot, the GILTI income also used to provide for a foreign tax credit mechanism in which you could offset some of your U.S. income tax with the deemed paid foreign taxes on this income. And you sort of combine them all together to determine what that amount was. Those foreign taxes now also would have to be considered on a country by country basis only. So really, really limit some of this mashing together income that's being earned in low tax jurisdictions with maybe losses that are earned in higher tax jurisdictions. It's eliminating those possibilities. In the end result will likely be that more companies will be subject to this GILTI tax. The one positive change that they have made in the GILTI regime is that under the current calculations, the deemed paid foreign tax was limited to 80%. So you could only apply tax up to 80% of the tax you could only use 80% of the tax pool to offset your U.S. income tax on the GILTI income. This is going to increase it to 95% of the tax. And it's also going to now allow any tax carry forward, any excess taxes to be carried forward. Under the old rules, any excess taxes related to this GILTI pool of income were lost. You got no carry forward. You couldn't carry back. You just lost them. So whatever that pool was, it did not carry forward. They're now going to allow a carry forward, and they're going to phase that carry forward in. It'll be 5 years, beginning in 2022 through 2031. You get a carryover for 5 years. And then after 2031, it will increase to 10 years. So there is some benefit that's included in these rules, but I think they really have done that because of the way they're changing the way these calculations are going to work. The other piece that's changing here is the GILTI calculation includes a allowable return on tangible assets or depreciable assets. They are changing that. So it's currently 10%. They're decreasing the amount of that fixed return. So more people will which will result in additional GILTI income. So a lot of pretty detailed calculations will have to be done to figure out what new GILTI looks like. And, I think a lot of practitioners have spent a few years developing some worksheets to help us do these calculations, and we're going to have to scrap those and start a little bit from scratch to consider all of these new regulations. A couple other items that are included in here are their limitations on the foreign tax credit. Again, they're adopting this country by country rule for foreign tax credits. So, the end result will be taxpayers unable to offset income from one jurisdiction with foreign taxes paid in a different jurisdiction. Sort of similar to what I just mentioned on the GILTI. We certainly have clients that may pay tax in China and no tax somewhere else, but you add the two together and you maximize your foreign tax credits that you can utilize. It's going to stop some of those planning opportunities that have existed. since the foreign tax credit regime has come into play, I believe, so that you now really have to figure out what your foreign tax credits are on a country by country basis. I think this will be a pretty big, a pretty big hill for us to sort of work our way through when we start implementing this. It reduces the scope of deduction for foreign source dividends. I'm not going to talk a ton about that because I don't see a lot of that. But currently in the Tax Cuts and Jobs Act, you essentially got 100% deduction for foreign source dividends for what they consider to be specified 10% owned foreign corporations. So if you own 10% of a specified foreign corporation, you generally got 100% deduction. This is in a C Corp environment. From that, it's now saying it has to be a controlled foreign corporation. So it's limiting the scope of who actually gets that deduction. And then there will be modifications to the base erosion and anti-abuse tax. They're changing, so this is a tax that's applicable to corporations with average annual gross receipts over a 3-year period over $500 million that make payments to foreign related parties that comprise more than 3% of total tax deductions. The current BEAT rate is a 10% tax rate. The new rules will phase in a new BEAT rate over time, beginning with an increase in 2021 to 12.5% and increasing up to 18%, ending in 2025. So the end rate will be 18% in 2025, but it also changes the calculations and it removes that 3% deduction threshold. So essentially, if you're a corporation with average annual gross receipts over $500 million and you make payments to a foreign related party, you will be subject to this BEAT tax. There's other calculations that go into it, but if you're one of these corporations, be aware that that's a pretty significant change to this calculation. A few other items to note that are included in this act are, it introduces several new clean energy credits. There's a lot of them out there. We don't really have time to talk about them all today. One of the big ones is a credit for the purchase of electric vehicles. This is one of the areas that Senator Joe Manchin is sort of disputing. He doesn't like the way it's worded, or I'm not sure that he really supports the credit at all, but we'll see where that ends up. But the credit as it is provided in there is pretty substantial. It's an additional $8,500 from where that credit was before. It subjects commodities, foreign currencies, and crypto assets to wash sale rules. Currently, those rules don't apply to these types of assets, and beginning in 2022, they will. And then the big one that I see, so the Tax Cuts and Jobs Act, one of the sort of under the radar regulations that was included in there is that it subjected research and development expenses to amortization. So currently, and that was beginning in 2022. Currently, as you're investing in research and development, those expenses have been deductible as incurred. And the regulations in the Tax Cuts and Jobs Act said, no, we're no longer going to allow you to deduct those as incurred. We're going to require you to capitalize those expenses and amortize them over 5 years. They've delayed that requirement from 2022 to 2025. So just a few year delay. And the big place, while it not only requires, a lot of huge companies that are doing a lot of investment in R&D to amortize those costs, if you're taking the research and development tax credit, you are saying that those expenses are R&D costs. And so to the extent that you had R&D costs that were qualified for the research and development credit, if this fix doesn't happen with this bill, the value of that credit becomes less, because a lot of times we see clients that have qualified research and development costs that are sort of included in their cost of goods sold or in wage expense. They're not really, they're qualified R&D costs, but they're not putting them into an R&D bucket. But for tax purposes, they're considered an R&D cost. So you would now be in a situation where some of your cost of goods sold are R&D costs, and you have to classify them as such to take the credit. And so those costs become not expenses as incurred, but you now need to put them into an R&D capitalized bucket and amortize them over 5 years. So for all of the practitioners in the R&D space, this has been something that we've been keeping our eye on, and it's been a pretty big change and a sort of viewed as a pretty big deal to have to sort of handle and figure out how do you justify the value of the R&D credit now when potentially that first year your taxes are going to go up because you're not going to have enough amortization built up. This will delay that requirement and sort of kicks the can down the road. I think everybody, when this piece of legislation was passed, it was passed as one of the levers that they pulled to balance the bill so that the Republicans in that instance could vote on it under the reconciliation package. And this was one of the revenue raisers to make that legislation more spend neutral or deficit neutral, if you will. And everybody recognized that that it would need to be addressed before 2022. There's been various bills raised in the House that haven't gone anywhere and not been supported just because it hasn't been that important. But it's important now because that change is supposed to happen on January 1st. So hopefully we see that extension, and then hopefully before 2025, we see an actual real fix. So what are some things that you can think about doing now in the light of potential increasing tax rates and some of the changes that we're seeing? Generally when we talk about tax planning, we talk about, deferring income and accelerating deductions. In years where you think that there's going to be a tax increase, you really sort of do the opposite and consider, are there ways that I should accelerate income and defer deductions where possible so that you're bringing that income into the lowest tax year you can, and you're moving those deductions out into a year in which they're a little more valuable because tax rates have gone up. The other item to consider is capital gain planning. A lot of times you come into the end of the year and you look at your portfolio and determine whether you should harvest losses in the current year or delay to offset future gains that could be taxed at higher rates. One of the things that we're seeing some people consider is, if I have some value in my portfolio, do I consider triggering those capital gains today, even if it's a sell and buy at the higher rate, to sort of now you've got a higher basis, so capital gains in the future may be less. And but it's really, you got to talk to your investment advisors and look at what's right for you. But really looking at, hey, is there things I should be doing in my portfolio to sort of capital gain plan for these surcharges that are coming, the investment income tax, the net investment income tax expansion, keeping all of those things in mind and looking at your portfolio to really be a little bit more intentional maybe than you are from year to year, because tax rates are expected to go up. Probably a little late. We're looking at December 8th right now, but to the extent that you have any M&A transactions, potentially accelerating them or thinking through, if I accelerate this, what is the impact compared to if I don't? If you were looking at a January 5th close date, could you close on December 31st instead? You might want to think about those things. If you had an installment sale in 2020, really think about whether or not you should elect the installment method. Especially if if your installment sale is known, right? Sometimes you have installment sales and you elect installment sale method because there's a piece that is uncertain. You don't know how much you're going to collect because there's an earn-out component, and so you don't want to pay tax on value that you don't end up getting. But there are other times where you're just going to get paid in installments, and generally you elect the installment sale method because you don't want to pay tax before you get the cash to pay the tax. This may be the year that you rethink that election to protect those lower tax rates, especially if your installment sale could push you into that 5% surcharge or that, 8% surcharge, plus the 3.8% net investment income tax. You really, really need to think about those things. And then consider conversion of a traditional Roth IRA or a traditional IRA into a Roth IRA. That's always a planning consideration that we talk about with our clients every year, but more so in years where you think the tax rates are going to go up. Now may be the time that you want to pull that lever. The state and local tax deduction, because that the change as written into the House is effective for 2021, you may consider paying fourth quarter estimates and winter property taxes in case the deduction is increased in the current year. Since the SALT cap has been implemented, a lot of my clients, it hasn't mattered whether they paid fourth quarter state estimates or property taxes in January or in December or in January, because they were going to be limited on that deduction. Now that it's $80,000, really relooking at those things to say, should I make these payments now or should I wait? Is it still not going to matter? I think it's a big one. Estate planning, a couple of things to think about here. So they haven't changed a lot as it relates to estate taxation. There were a lot of items that were on the table and none of them made it into the bill. But that increase, we're currently with a lifetime exemption that's around $11 million. It gets increased for inflation each year. I don't know it off the top of my head this year, but 11.3 or $11.5 million. That's still scheduled to drop back to pre-Tax Cuts and Jobs Act levels. I think they're projecting it's going to be around $6 million with all the inflation adjustments that would have happened. That's scheduled to drop at the end of 2025. So really, really looking at that and looking at, are there ways that I can be maximizing that lifetime exemption before it drops, before it goes back down at the beginning of 2026. The IRS has codified, meaning it's legislative law, that they will not claw back taxes on any funds gifted under the current law. Meaning if you fulfilled your lifetime exemption today, and 2026 comes about and it goes back down to $6 million, the IRS is not going to come back and value claw back the taxes on the excess amount that you've already gifted, because you've gifted those amounts during a time in which the law had a higher exemption. So they will not claw those amounts back. So you should really be talking with your estate advisors to see what you may be able to do before that exemption, that increased exemption sunsets, and make sure you're able to maximize your gifting ability while you can. We always suggest continue looking at your plans today and making sure that your advisors are following where the legislation, the proposed legislation, where things are sort of reading the tea leaves as to where we think things are going to go, so that you are prepared for a law change. Back over the summer when there was a lot of anticipation for changes in this world, we talked to a lot of our clients about looking at the plans and figuring out, okay, well, if this actually becomes legislation, these are the things that we want to do so that you're prepared. Because one of the things we knew is that the estate attorneys who draft the documents, once legislation changed, they get so busy so fast, and it takes a long time for sometimes those new documents to get drafted and accepted and signed. So you sort of wanted to be prepared to be at the front of the line, so you knew what you needed to do and you had your ducks in a row. So really thinking about those things, I think, is important in that world. And then, I talked about this a little bit, installment sales closing in 2020, making sure you're looking at it and saying, and identifying whether it still makes sense to elect the installment method, or maybe you consider electing out and paying the tax all today, so that you protect those lower rates that still exist.
Sarah, I may be jumping the gun here a little bit, but we do have some questions on ERC. And so do you have any insight on, we know Q4 was repealed, whereas they can't take the credit. Are you aware of any relief that's available for maybe underpayment penalties because they planned on it? Can you shed any light on what's happening related to the ERC?
Yeah, I'm still waiting for guidance from the IRS on that. I haven't seen anything come through. If it came through this morning, I would not have read it. So unless something's come through today, no, I have not seen any further guidance. I know the AICPA has requested guidance from the IRS on this exact issue. There's certainly a lot of taxpayers that withheld the payroll taxes for that first month before they changed the rules. So, take solace in knowing you're not alone. And we are, as soon as I see something from the IRS, you can be assured that we will get a very quick blog post out to inform everybody as to what that relief looks like or how to make the payments. I think right now there's still uncertainty as to how they even make the payments. I know I have one client who uses a payroll provider, and the payroll provider said, we can't remit the taxes because we don't know how. And there was a little bit of, that doesn't make a whole lot of sense to me. But it does make sense, because if you think about where payroll taxes are going, they're going to individual accounts, right? They're getting credited to your employees' Social Security accounts. And so I think that the payroll providers don't exactly know what that mechanism is. How do they remit these taxes and make sure that the amounts get applied the right way? And the IRS definitely has to come out with something to help everybody sort of navigate that. So I don't have an update, unfortunately. But since we're talking about the employee retention credit, this was one of my other planning considerations is, I think that a lot of clients really understood the simplicity of, do I qualify for this employee retention credit or not, based on a gross receipts, right? If you had the drop in gross receipts, it was pretty bright line, simple calculation, easy to navigate and determine qualification. One of the underlooked and pretty gray areas that's in the legislation is that, the legislation as drafted said, it's possible you could benefit from the employee retention credit for other reasons, right? If you had a government shutdown, that was not quite as easy as the gross receipts calculation, but still relatively easy to understand. But they also included in that language was, if you had suppliers, so you had supply chain issues that had significant impact on your business due to government shutdowns. That part is much, much more gray, and there's a fair amount of clients who are really taking a look and saying, well, I did have a supply chain issue. There was reduced workforce at the ports in LA because of restrictions that existed in LA County. And so I had, shipping containers sitting in Los Angeles, at the port in Long Beach for, 90 days before it actually made it onto land. And does that qualify me? That's a little bit of it's certainly a very facts and circumstances driven scenario that you have to look through. And then also understand that it's gray, very gray area, that the IRS hasn't issued a ton of guidance as to what that means. And so taking the credit under those constraints is more time consuming and certainly requires substantially more documentation than the gross receipts qualification. But due to the significance of how much these credits are, it may be worth re-looking at. I certainly have several clients that are still growing, didn't have that 20% dip in gross receipts, but have really suffered because of supply chain issues, haven't been able to meet deadlines, haven't had the volume that they could have had those supply chain issues not existed. And so I know there are credit firms out there that have databases that they're using to look at and say, yep, these supply, if you have business with these suppliers qualify, we've taken the position that these suppliers qualify. It's more time consuming. It certainly costs more money to go through the analysis. But if you're one of those companies that have had significant supply chain issues, I'd really urge you to take a look at it and see if it makes sense for you to go back and claim those credits for the first 3 quarters of 2021, or whichever quarter you think that would apply to you. Tara, were there any other questions right now?
One last one, and we are just about at time, and I don't think I've seen anything about this, whether the proposed legislation deals with QBI at all. And I don't.
It does not. QBI stays in the legislation. So you still get, as a pass-through deduction, you still get that 20% deduction. The one last thing I wanted to mention really quickly here is one thing to consider this year is charitable giving. The CARES Act allows a deduction for up to 100% of adjusted gross income through the end of this year. So if you're one of these very charitable people, one planning opportunity is to consider setting up a donor advised fund, and you can put a sum of money into that fund. You get the deduction this year, and then you can make the charitable contributions out of that fund into the future to maximize this AGI limitation. Is a big planning opportunity I'm seeing, especially with the high net worth individuals, to consider. But so we are a minute over. I apologize for that. I'm more than happy to answer questions if there's any other questions. We thank you guys for your time today. As Tara said, we'll have a link on our website with to the presentation if you wanted to go back and take a look at or pass it along to any of your employees. We'll certainly keep updated, and we'll, it's been a couple of weeks since we sent out our insights from Washington, but we'll probably start those back up again next week. But with that, I think we can end it. I thank everybody for your time. Everybody have a great day.